everybody. My name is Luis Galvez, Senior Marketing Manager at Wolters Kluwer Tax and Accounting. And joining me today is Mark Luscombe, lawyer, CPA, and Principal Tax Analyst at Wolters Kluwer. Mark is a key member of our tax legislation team that tracks, reports, and analyzes tax legislation before Congress. And he's here to review some of the tax law changes impacting 2021 tax returns.
Thank you, Luis, and welcome everybody. So this promises to be another exciting tax filing season. Some people think the last tax filing season is still not ended, and certainly in the case of the IRS, that's the case. They still have millions of tax returns from last year that they're still trying to process. So if you have been waiting for inquiries from the IRS, that's probably why you have not heard. But let's talk about what the upcoming tax filing season is going to look like. The IRS has, in sort of a somber announcement, predicting a problem tax season, did announce a fairly normal tax filing timeframe to start January 24th and end April 18th. The April 18th date due to some weekends and holidays that forced it to be put off for 2 or 3 days. So let's talk now about some of the things we're going to cover here. So for individual tax planning, we're going to talk about the child tax credit and the advance payments, the economic impact payments, and the recovery rebate credit, which would be a sort of a similar issue that we dealt with on the 2020 tax returns, the enhanced child and dependent care credit, the enhanced earned income tax credit, the enhanced premium tax credit. Those are all new for 2021. The charitable contribution deductions, which are similar to 2020 with some minor modifications. The charitable contribution deductions, which are similar to 2020 as well. And then the business meals deduction is something new for 2021. And then a few changes to the cryptocurrency situation that I want to talk about. And finally, we'll talk about the state and local tax deduction cap, which has not, no revision has been enacted yet, but a retroactive provision to 21 was proposed in the Build Back Better bill in the House. So I do want to highlight that for you. So let's move on now to the enhanced child tax credit. So I'm sure you were dealing with this the latter half of last year with people starting to receive these payments and wondering what they were and whether they should opt in or opt out. So you're probably very familiar with that issue. On the whole, the expanded tax credit, child tax credit, although it raised the amounts, did not raise the income scope of the people eligible for them. So in that sense, there should not be a lot more people eligible for the child tax credit as compared to past years. They'll just be eligible for a larger credit. The one exception to that is because it was not fully refundable in the past and now is fully refundable. There could be some people at the lower income spectrum who were not eligible for the credit because they didn't have enough income to qualify. Now that it's fully refundable, those people should qualify for the full credit. So that should help somewhat. It gets a little confusing because the enhanced amounts starting in 2021 have a different phase-out income range than the original amounts. The original amounts still have the same income phase-outs. The enhanced amounts have a lower income phase-out. So that's going to add a little complication to the calculation. There is, unlike the economic impact payments that we've been dealing with in the past year, if you receive too much advance child tax credit, you have to pay it back on the 2021 tax return. You don't get to keep any excess. And that could raise some issues. Some people who end up having gotten more advance credit than they're entitled to could end up being under withheld for the year, which might create a penalty situation. So that's something you might want to look at with your clients. We still have one more period to maybe address that. January 15th has just passed, but you could get in perhaps a late estimated tax payment if you do have clients that might be potentially in an under withholding situation because they get too much advance child tax credit. The one important thing to remember on the child tax credit is the most important document you probably should get from your clients is a letter 6419, and that will be the letter from the IRS telling the taxpayer what they feel they got as an advance child tax credit payment for the 2021, and that'll have to be taken into account on the 2021 tax return. Let's move on now to economic stimulus payments, the third round. So you may recall we had the first round was in 2020. The second round was in early 2021, but related to the 2020 tax return. And then we had the third round starting in March of 2021. Now, this is probably going to further confuse your clients because they've got two sets of payments in 2021, but only one set of payments will relate to the 2021 tax return. So that's something you're probably going to have to make sure that when the clients give you the documentation for what they received in these economic stimulus payments to calculate the recovery rebate credit, that you're only including the third round of payments, not the second round of payments. This third round of payments should be documented on a letter 6475, which also is coming from the IRS to document these economic stimulus payments. And as was the case with these payments last year, and unlike the child tax credit, if taxpayers get too much economic stimulus payments than they're entitled to on the recovery rebate credit, they may retain the difference. They do not have to pay it back to the IRS. Let's move on now to another enhancement under the American Rescue Plan Act in 2021, enhanced dependent care assistance. So the child and dependent care credit was enhanced considerably in 2021. The percentage increased from 35 to 50%. The dollar amount of eligible went up, and the income thresholds went up. So unlike the child tax credit, I think you could have a lot of taxpayers who are now eligible for the child and dependent care credit for the first time. And you'll want to alert your clients to that possibility. But that also comes with a problem, because to claim the child and dependent care credit requires the taxpayer to have kept documentation of the names of the care providers and their taxpayer identification numbers. So if they have not done that, they may have some work ahead of them to go back and get that documentation in order to claim the child and dependent care credit on the 2021 tax return. Let me say one more thing about the Child and Dependent Care Credit. The Build Back Better bill that was in the House extended most of these enhanced provisions from the American Rescue Plan Act, but did not include an extension for some reason of the enhanced Child and Dependent Care Credit. Looks like the Senate might be including something in that regard, so it may not be dead yet, but at least there's an issue in the House version that this Child and Dependent Care Credit enhancements were not proposed to be extended by the House. So let's move on now to the enhanced earned income tax credit. And this, like the child and dependent care credit, could make the earned income tax credit eligible for a lot more taxpayers, particularly childless taxpayers. There was an increase in the maximum level, the threshold phase out, and also the age was reduced from down to age 19, except for full-time students. So a lot more people should potentially be eligible for the EITC. This change was for 2021 only, but again, the Build Back Better bill would propose to extend that into the future. Some other changes with respect to the EITC were made permanent. So a person with children who do not have proper taxpayer identification to claim the EITC, that parent can claim the childless EITC now and not be kicked out just because their children do not have the identification requirements. Also, married but separated taxpayers can also claim EITC as unmarried, provided certain requirements with respect to the children are met. So both increasing the possibility for people being entitled to the EITC. Also, that might help eligibility is the investment income amount increased. The maximum threshold increased to $10,000, and that's going to be adjusted for inflation after 2021. So that that also should enhance the people eligible for the EITC. I don't know how many of you work with clients eligible for the EITC, but it's probably is a lot more important to a lot more people now. Let's move now to the enhanced premium tax credit. So these are the tax credits associated with insurance on the insurance exchanges under the Affordable Care Act. So again, there could be a much more generous eligibility for the premium tax credit. I understand that there have been many more people getting their insurance under the exchange this year than in the past, perhaps enabled by the more generous premium tax credit. So the income level that you're eligible for the premium tax credit has increased. The credit amount has increased. These changes are effective for 2021 and 2022. So this is one that does not have to be wait for the Build Back Better legislation to extend into 2022. And it's also for 2021 available to individuals receiving unemployment compensation. So that can count in the calculation of entitlement to the premium tax credit. Let's move now to enhanced charitable contribution deductions. Well, these came from the Consolidated Appropriations Act 2021, so you dealt with these on the 2020 tax returns already, and so this was enhancements to not only corporate percentages of charitable contribution deductions, but also the itemized deductions that you've all been familiar with. The percentages were increased from 60% to 100%, and those are still available for 2021. The deduction for non-itemizers that was new for 2020, that for 2020 it was a $300 deduction, maximum deduction, and it was an above-the-line deduction. So for 2021, that has changed a little. It's still basically $300 for individual filers, but now for married filings jointly, it is increased to $600. That was a confusing point last year, and it was finally resolved that it was only $300 for 2020 for married filing jointly, but now Congress has acted to, probably their intent all along, to double it to $600 for married filing jointly. The other change is that for 2020 it was an above-the-line deduction, and for 2021 it's a below-the-line deduction. Not exactly sure of the reason Congress made this change, but on the whole, this is probably disadvantageous. It no longer would lower AGI, and as you know, AGI is a factor determining the phase-out range for a lot of deductions and credits. So it's probably a disadvantage now that it is a below-the-line deduction in 2021. And currently these do expire after 2021, so they are expired for 2022. An extension was not included in the House version of the Build Back Better bill, so I don't know if there's a plan to extend this or not. You know, a charitable deduction for non-itemizers has been talked about for years, so I think there would be some incentive to continue this at least in some form. But at least at this point, it's expired for 2022. Let's move now to the business meals deduction, and this is new for 2021. This was designed to help the restaurant industry, and so the 50% limit on business meals for 2021 and 2022 has been increased to 100%, and it applies to both meals and beverages. So some people are referring this as a return to the 3-martini lunch. It is limited to meals provided by our restaurant, but it doesn't have to be on the premises of the restaurant. It can be delivery or takeout. But IRS has provided guidance on what constitutes being provided by a restaurant. Let's move now to cryptocurrency reporting. We have for the last couple of years had a question on the 1040 about cryptocurrency. That question has been revised a little for 2021. Let me read you what the 2021 question is. At any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So a little different language, and may require some people to have a little different answer than they did on the 2020 return. But it's something to take a look at with your clients who have engaged in cryptocurrency transactions. Also becoming sort of a hot item in 2021 has been non-fungible tokens. They've been much in the news, and even professional sports teams and entertainment people are getting involved in offering non-fungible tokens, and they've been going for what sometimes seem like astronomical prices. So like cryptocurrency, it's not the purchase of the asset that is the taxable event, but the disposition of the asset. So in the case of the creator of the non-fungible token, it's going to be a taxable event, but to the purchaser of the non-fungible token, it's not taxable until they dispose of it. And we do not have any specific guidance from the IRS yet on non-fungible tokens, but because they are typically handled on a ledger similar to cryptocurrency or through an exchange, similar to cryptocurrency, a lot of people think that the best guidance we have as to the tax treatment of non-fungible tokens at this point is the IRS guidance on cryptocurrency. So we are sort of going with that thought until the IRS gives us some better guidance. So let's now move to the SALT deduction limit. As you know from the Tax Cuts and Jobs Act from 2018 on, we've had a $10,000 limit on the state and local tax deduction, which combined with the increase in the standard deduction from the Tax Cuts and Jobs, that resulted in relatively few people taking itemized deductions these days. I think it's estimated that only about 10% of individual taxpayers claim itemized deductions. But one big factor in that is this $10,000 limit on state and local tax deductions. And that is still the limit for 2021 at this point. But one of the few provisions in the Build Back Better legislation that was in the House and passed the House that was retroactive to 2021 was an increase in the SALT deduction limit. The House version would have increased the limit from $10,000 to $80,000 for 2021. So that could be a significant change if it were enacted, and could cause a lot of more people to be eligible for itemizing their deductions rather than taking the standard deduction. And as we saw from last year with the exclusion for unemployment compensation, which happened in March, sometimes Congress is very capable of putting in retroactive changes well after the tax season has started. So that's something to really watch with continuing efforts to pass at least part of the Build Back Better legislation in Congress, whether this retroactive provision on the SALT deduction limit could still come back to apply to 2021. The Senate the Senate Finance version of Build Back Better just left a placeholder without stating any particular proposal, said it was just being subject to further negotiations. Although earlier discussions from the Senate said that they would eliminate any limit on the SALT cap for people earning under $400,000 and keep that $10,000 cap in place for people with income above that amount. So that's really one of these cliff thresholds where it's you get the full deduction under $400,000 or the $10,000 cap over that. But we don't know what the provision will be. We don't know if anything will get enacted. And currently for 2021, it's still a $10,000 cap, but certainly something to keep your eye on. Just a few more things I wanted to throw in and mention. There are a number, the Consolidated Appropriations Act at the end of 2020 extended a number of these regularly expiring provisions. Some were only extended through 2021, some through 2025, some made permanent. So for individuals, there were several that were expired at the end of 2021. So they're listed here on this slide: the mortgage insurance premium treated as qualified residence interest, the credit for health insurance cost of eligible individuals, the credit for non-business energy property, that's that credit, $500 lifetime credit for energy efficient improvements to windows and doors, that sort of thing. And then the credit for new qualified fuel cell motor vehicles, the credit for alternative fuel cell refueling property, and the credit for two-wheeled plug-in electric vehicles. So those were all available for 2021. They've expired for 2022. The Build Back Better legislation in the House had a number of green energy provisions, and those included extension of all these energy provisions I just talked about, but not including the non-energy provisions. So there was no provision, for example, to extend the mortgage insurance premiums being treated as qualified residence interest, or the credit for health insurance costs for eligible individuals. So that's also something to keep your eye on for 2022. They are available for 2021, so that's not an issue for 2021 tax returns, but they're, as we've seen with these regularly expiring provisions, sometimes they're allowed to expire and then retroactively extended at the end of the following year. So they may all return, but we just don't know that yet. Also, just wanted to throw out COVID expenses are allowed for a number of things now through legislation. They're allowed. They can be classified as deductions for educator classroom expenses. They can be classified as medical expenses. If you itemize, they can be included as qualifying for flexible spending account distributions and health savings account distributions, and to support penalty-free distributions from retirement plans. So COVID expenses are allowed for a number of things now. And there have been a number of provisions in the law clarifying exclusions for various items related to COVID, the student loan forgiveness, financial aid grants to college students, economic injury disaster loans, targeted economic injury disaster loans, and restaurant revitalization grants are all now eligible for exclusion and not subject to tax on the 21 tax return. And with that, I think that pretty much wraps it up. So good luck with the upcoming tax filing season. It promises to be a very difficult one, as the IRS is saying that refunds may be delayed, processing may be delayed, and it'll be hard to get a hold of them on the phone. They're encouraging you to file early and to use the online services of the service rather than trying to reach them by phone, to avoid frustration for another tax filing season. And I wish you all good luck and the best. Thank you.
Thank you, Mark. This is great information for our tax professionals looking to better understand how the recent tax legislation changes are affecting this year's tax returns. To download a copy of today's presentation, please visit engagetax.wolterskluwer.com/tax industry news. Thanks again, everybody, and we look forward to seeing you next time.